Hello and welcome to our final video of the series. In this video, we'll continue talking about dividend policy. No mini exercise in this video, and let's get back to what we want to understand. So we left off looking at key points in the lifespan of a dividend and talked a little bit about how companies pay out cash to shareholders generally. In this video, the key things I want you to understand is how dividend payout policy might affect the goal of the corporation, right? Creating value for shareholders. Because there's some sort of optimal percentage of money that a company could pay out in dividends to make it more valuable. Shareholders would love that. Let's start with a couple examples of guess the ticker and use those as illustrative examples. The first, these are companies we've heard of, I would hope. Coca-Cola companies, Coca-Cola Inc., guess the ticker, KO. Interesting, right? I think it comes from the cola nut, which is spelled with a K. But Coca-Cola has paid out about 90% of its net income as dividends over the last 5 years. So that's a high payout ratio. Contrast that with a different company, software company, Adobe Systems Inc. Guess the ticker, Adobe Systems. Ooh, if you guessed ADBE, you nailed it. Adobe Systems has never paid out a dividend ever. So their payout rate, they pay out none of their net income as dividends. They reinvest all their profits back into the firm to grow. The question is, which is better, right? So a couple ideas I want you to think about and understand. This first one, that dividend policy doesn't matter, let's skip that and get to some sort of theories about why paying more dividends might be better or less dividends. So first, on high dividends, a company like Coca-Cola paying out 90% of its net income. Remember the two parts of any investment's return, the income component and the capital gains component. So dividends are the income component for a stock. And we saw in the chart earlier that dividends have grown sort of steadily over time and they're not all that variable, even though the market is really volatile. So if you look back at that graph, that shows how the market is variable, but dividends kind of creep up over time. If this component of an investment's return is less risky, then maybe it's worth more today if we apply a lower discount rate to companies that pay out a lot of net income as dividends. Does that make sense? So if a company pays out a lot of its net income as dividends, it might be viewed as less risky by investors because the income component is less risky, and if it's a lower discount rate on the investment, the stock will be worth more, right? And that's the goal of the corporation, to create value for shareholders. So that's kind of the bird in the hand idea, right? If I get this income component, it's less risky, and so maybe stocks that pay high dividends are worth more because of that. A couple others are related to maybe information asymmetries or supply and demand, right? So if there's some investors that just really value a steady income stream, that really want stocks that pay dividends, whether it's like, if I'm living on a fixed income and I still want to have some stock in my portfolio, maybe I like high dividend stocks like Coca-Cola because I can count on that regular cash flow that the dividend provides, the clientele effect. So if there's increased demand for stocks like that, those stocks will have higher prices, right? Because higher demand leads to higher prices. And then dividends could be a signal of quality, and a commitment to pay out money to shareholders could be viewed as like a positive thing. Oh, this company is successful enough that it can pay out cash to shareholders, and it's big and stable, and it's going to be around for a while. So, and then I suppose another idea is that if a company, if we're worried about managers behaving at a firm, misusing firm profits for their own personal well-being, right? Birthday parties in Italy and such, then a firm that pays out a lot of its net income as dividends could mitigate those fears, right? It could be one tool to manage agency costs. And so all three of these things, along with the bird in the hand theory, right, are sort of rationales or intuition about why people might want to pay more money for stocks that have high dividends, right? So a couple theories on why high dividends may be associated with larger firm values, other things equal. So contrast that with some ideas about why low dividends might be better for some more desirable for some investors. Back in the 80s, if we look at how dividends versus capital gains were treated for tax purposes, it looks like, if I was living in the 80s, I would prefer capital gains as a source of income much more than dividends because the tax rate is 30 percentage points lower. Um, these days, dividends and capital gains are taxed at about the same rate. And actually, what we observe is that dividends were actually much more popular back in the 80s, and they tend to be less popular today because more firms are paying out cash to shareholders by repurchasing shares of stock. So that kind of goes in, like what we observe kind of goes in the opposite direction of the intuition there. So the tax treatment of dividends has changed so that investors should be sort of like indifferent on a tax basis. But you can see how taxes would be one idea why a firm that pays out less dividends might be worth more. So those are the two main things I want us to understand. Some intuition behind why firms that pay out a lot of net income could be worth more. Right? And then this tax treatment of low dividends, maybe firms that pay out not a lot of dividends, if there's a tax reason why firms that don't pay out a lot of dividends could be more valuable. There's certainly tons more to talk about in terms of firm payout policy and dividends and share repurchases. If you'd like to get into it further, it's another sign that maybe you should be a finance major or minor. Come talk to me about that. Or if you've got questions, just let me know. Thanks as always for tuning in.